Imagine waking up one morning and seeing one of your stocks are up 200, 300, or even 500% overnight. Sounds like a dream, right? Well, in the world of biotech, that dream can turn into reality because this is the one sector where a single FDA approval or a breakthrough clinical trial or a big pharma buyout can send a tiny penny stock skyrocketing in a matter of hours. And in this video, I'm going to show you exactly where I believe that next explosion could come from. I've been tracking 3 biotech penny stocks that are perfectly positioned for a massive breakout. And trust me, these aren't just hype plays or Reddit pump and dumps. These are real companies with real science, real pipelines, and in some cases, real revenue. So if you're serious about investing and you want to get into high-growth biotech stocks while they're still flying under the radar, make sure to watch this video till the end, because these names could soon be on every investor's watch list. And if you haven't already, make sure you hit that subscribe button and turn on notifications so you never miss my next big stock pick. Let's aim for 100 likes on this video so more people can reach and benefit from this info. The first stock I want to talk about is Theratechnologies, trading under the ticker symbol THDX on the NASDAQ. This company is based in Canada and is focused on developing and commercializing therapies in the HIV and oncology spaces. And it's not just some speculative pre-revenue biotech company. Theratechnologies already has 2 FDA-approved products that it's actively marketing in the United States, Egrifta SV and Trogarzo. These aren't experimental drugs. These are already generating significant revenue and putting this company on a growth trajectory that's caught the attention of institutional investors. The stock has absolutely taken off recently, rallying more than 65% over the past month alone, and analysts believe there's more upside to come. Let's dig deeper into what's really driving this momentum. First, Egrifta SV is the only FDA-approved therapy indicated to reduce excess abdominal fat in HIV-infected patients with lipodystrophy. This is not just a cosmetic issue. It's linked to significant health risks, including cardiovascular disease. Egrifta SV is a long-acting formulation, which gives it a competitive edge because it offers convenience and better compliance compared to earlier treatments. The company has been steadily expanding its market share in this niche. And in the last reported quarter, sales of Egrifta SV were up nearly 45% year over year, reaching $17.7 million. That's a huge contributor to the company's total revenue and demonstrates solid demand growth. The second key product, Trogarzo, is used for multi-drug-resistant HIV. It's a monoclonal antibody and is one of the few options available for patients who have run out of alternatives. Trogarzo brought in $7.3 million in sales last quarter. While its sales aren't growing as fast as Egrifta SV, it still holds a crucial position in the company's portfolio, and the company has been actively working on expanding its international reach. In fact, Theratechnologies has made significant progress in Europe, where Trogarzo has been approved in multiple countries. With continued penetration into new markets, both products are expected to see steady revenue growth over the next few years. From a financial perspective, Theratechnologies is making impressive progress. In fiscal year 2024, the company reported total revenue of $82 million, up sharply from $70 million the year before. Importantly, the company turned adjusted EBITDA positive, hitting $20 million compared to a $3 million loss the prior year. That's the kind of turnaround story that excites investors. Gross margins on Egrifta SV are above 90%, which is exceptional, while Trogarzo has gross margins around 48%. That combination gives the company healthy overall margins and a clear path toward profitability. However, it's not just about the top line. The company has been very disciplined with expenses. Research and development costs actually fell to $2.4 million in the latest quarter from $5.2 million a year earlier. This is largely because the company has completed several key development projects and is now focusing on commercial execution. Selling and administrative expenses did increase to $13.4 million, reflecting higher sales force costs, marketing, and international expansion efforts. But these investments are critical for sustaining long-term growth. On the balance sheet, Theratechnologies had $19.8 million in cash at the end of November 2024. While not a massive cash cushion, it's enough to support ongoing operations, especially as the company generates positive EBITDA. Analysts have a $3 price target on the stock, which is currently trading around $2.74. That's roughly 10% immediate upside just on valuation alone. But the real kicker comes if positive earnings surprises or a buyout announcement hits the wires. Wall Street sees this as a stock with both fundamental strength and strategic optionality, a rare combination in the biotech penny stock world. That said, Theratechnologies has a strong market position today and is executing well on its strategy. For investors looking for a biotech company with approved products, strong revenue growth, improving profitability, Theratechnologies is definitely worth watching closely. Now let's move to the second company I want to highlight, MannKind Corporation, ticker symbol MNKD. This US-based biotech is a fascinating story because it's redefining how we treat chronic diseases like diabetes and pulmonary hypertension. The company's flagship product is Afrezza, an inhalable insulin powder. This is a major innovation because it eliminates the need for mealtime injections, making diabetes management much more convenient. Afrezza was approved by the FDA several years ago, and MannKind has been steadily growing its market share. In the fourth quarter of 2024, Afrezza brought in $18 million in revenue, an 18% increase year over year. For the full year, Afrezza generated $64 million, up 17% from 2023. That's a clear signal of strong underlying demand. What makes Afrezza particularly exciting right now is MannKind's plan to expand into the pediatric market for type 1 diabetes. The company expects to submit an application for pediatric approval in the first half of 2025, with potential approval by early 2026. This is a huge market opportunity. There are over 300,000 children in the U.S. living with type 1 diabetes, and if MannKind can capture even a small portion of that market, it could add hundreds of millions of dollars in annual revenue. Pediatric patients often struggle with injections, and an inhalable insulin option could be a game-changer for compliance and quality of life. Beyond Afrezza, MannKind has other revenue streams. Its Tyvaso DPI product, developed in partnership with United Therapeutics, is used to treat pulmonary hypertension. This is another high-growth segment, and MannKind earns manufacturing and royalty revenues from the partnership. Financially, MannKind has been strengthening its balance sheet. The company reduced its total debt principal by $236 million in 2024, a significant deleveraging move that improves financial flexibility. It ended the year with $203 million in cash, providing ample liquidity to fund operations and development programs. The company is still investing heavily in R&D, especially for its endocrine and respiratory franchises, but its revenue growth and improving cost structure give a clear path toward profitability. MannKind has strong intellectual property, innovative products, and a growing global footprint. Analysts see significant upside in the stock, which is currently trading around $4.84. Importantly, 29 hedge funds hold positions in MannKind, which signals institutional confidence in the company's future. If the pediatric Afrezza indication is approved, it could be a major revenue driver and catalyst for the stock. Let's turn now to the third and final stock on my list, TuHura Biosciences, ticker symbol HURA. This is a newer name in the public markets, having recently uplisted to the Nasdaq, but it's already generating a lot of buzz. TuHura is focused on personalized immuno-oncology, particularly therapeutic cancer vaccines. Its lead candidate, IFX 2.0, is designed to be used in combination with Merck's blockbuster drug Keytruda. This is a smart strategy because Keytruda is already the standard of care for many cancers, and combination therapies can enhance its effectiveness. TuHura is preparing to launch a pivotal phase 3 trial for IFX 2.0 in 2025, targeting advanced melanoma patients. Enrollment is expected to complete by the end of next year, and top-line results could be available in early 2026. If the trial is successful, IFX 2.0 could become the first approved personalized cancer vaccine for melanoma, a multi-billion-dollar market opportunity. In March, H.C. Wainwright initiated coverage of TuHura with a buy rating and a $13 price target. That's more than triple the current share price, which is around $3.83. Over the past month, the stock has surged nearly 70%, reflecting growing investor enthusiasm. Financially, TuHura is still in the pre-revenue phase, which is typical for a clinical stage biotech. In 2024, it reported $17.6 million in R&D expenses and a net loss of $21.7 million, or $1.16 per share. That's actually a narrower loss compared to $29 million in 2023, thanks to cost controls and disciplined spending. The company raised capital through its uplisting and is well-funded to complete its Phase 3 trial. Most of the spending has gone toward advancing IFX 2.0, as well as earlier stage programs like IFX 3.0 and a platform targeting myeloid-derived suppressor cells, which play a key role in tumor immune evasion. What's particularly exciting about TuHURA is its platform approach. Unlike traditional cancer therapies, which target tumors directly, TuHURA's vaccines aim to train the patient's immune system to recognize and attack cancer cells. This personalized approach has shown promising results in early trials, and if validated in Phase 3, it could represent a paradigm shift in oncology. The company is exploring additional indications beyond melanoma, including head and neck cancers and non-small cell lung cancer. Each of these represents a multi-billion-dollar market opportunity. Of course, investing in clinical-stage biotech companies comes with significant risk. Clinical trials can fail, regulatory hurdles can delay approvals, and competition is fierce. But the potential rewards are enormous. If IFX 2.0 succeeds and gains FDA approval, TuHURA could go from small-cap biotech to a major oncology player in just a few years. Analysts estimate the company's addressable market could exceed $5 billion annually, and partnerships with big pharma companies like Merck could accelerate commercialization. For investors willing to accept the risks, TuHURA offers asymmetric upside potential that's hard to ignore. To wrap things up, these three biotech penny stocks, they represent some of the most compelling asymmetric bets in the biotech sector today. If you're serious about investing in high-growth biotech stocks, now is the time to pay attention. These are companies with real products, real pipelines, and real potential, not just speculative hype. As always, remember to do your own research, understand the risks, and consult with a financial advisor before making investment decisions. If you enjoyed this deep dive and want more in-depth coverage of under-the-radar stocks with massive upside, make sure you hit that subscribe button, turn on notifications, and stay tuned for the next video. Thanks for watching, and I'll see you in the next one.